right, let's get straight to work and dive right into this. Welcome to Iron Financial, the explainer where we forge stronger portfolios, cut through market weakness, and build your wealth on an absolute ironclad foundation. I am your lead analyst, and as always, I am joined by the market skeptic to keep us honest. Today, we are doing a heavy metal drill down into Micron Technology's Q3 2026 earnings. And let me tell you right out of the gate, the numbers we are smelting today are made of pure structural concrete. If you want to keep your portfolio forged in steel and stay ahead of these massive market shifts, hit that subscribe button right now.
Glad to be here, and trust me, we need to talk about this because June 24th, 2026 was pure, unadulterated chaos on the trading floor. This stock swung like a literal wrecking ball. During the regular session, we saw Micron fall 11% intraday. Algorithms were going absolutely haywire, stop losses were triggering left and right, and it was completely shaking out the weak hands. People thought the thesis was dead. And then immediately following this earnings print, the stock skyrocketed roughly 15 to 16% in after-hours trading.
So my question for you is incredibly simple. Is this 15% explosive momentum actually built to last, or is this just another hype cycle propped up by temporary AI euphoria? Because we've seen this movie before, and usually it collapses the moment reality sets in and the initial excitement fades.
I completely hear you. You're looking for cracks in the armor. You want to know if the steel is truly tempered this time around. But you really have to look at the sheer velocity of the market's realization here. Wall Street had a complete and total paradigm shift practically overnight. We aren't just talking about a modest beat that justifies a quick little pop in the share price. We're talking about a total, fundamental re-rating of what this company is structurally capable of earning over the next decade.
Well, I'll believe that when I see the actual blueprints. You need to prove to me that Micron's new business model is actually poured in structural concrete, because historically speaking, memory is just a commodity. It's the ultimate cyclical trap waiting to crack your portfolio wide open. The cycle is always the same. Demand drops, pricing collapses, and those massive profit margins completely disintegrate back down to earth. Challenge accepted. We are about to smelt some granular financial numbers that will completely rewrite your risk models from the ground up. The days of treating Micron like a simple cyclical commodity producer are over. Let's look at the raw data and start pouring the foundation for why this time is fundamentally different.
Let's begin processing the headline data because it is staggering. Fiscal Q3 2026 revenue came in at a massive $41.46 billion.
Hold on, let me stop you right there so we can put that in context. The street consensus was modeling roughly $35.8 billion. Are you seriously telling me they crushed Wall Street's expectations by nearly $6 billion? That is not a rounding error. That means the forecasting models used by the top analysts were fundamentally broken.
Exactly. They were completely disconnected from the reality of the business, and the year-over-year expansion basically defies gravity. Look back to the prior year, FQ325. Total revenue back then was just $9.30 billion. We are looking at a company that just went from $9 billion to over $41 billion in a single year. That led to a GAAP net income of $28.24 billion. Non-GAAP earnings per share came in at a massive $25.11, completely blowing past the consensus of $20.20.
Okay, a beat is a beat. The top line numbers are massive. I will absolutely give you that. But as the old saying goes, revenue is vanity and profit is sanity. How much of this is just top-line fluff getting eaten up by the massive costs of scaling these cutting-edge chips? Memory fabs aren't exactly cheap to run.
And that brings us to the most important metric of the entire quarter. Look closely at the quarter-over-quarter comparison from Q2 to Q3. Revenue increased sequentially by $17.596 billion. But the cost of goods sold? It only went up by $295 million.
Wait, let me run the math on that really quick. So almost every single new dollar in revenue flowed straight through to the bottom line?
You got it. It's a 98.3% incremental gross margin on new revenue. This is exactly what a fixed-cost manufacturing business looks like when pricing power is structurally locked in. Think of it like a massive heavy industry project. You build the fab. You pour the concrete. You install those insanely expensive EUV lithography machines. That capital expenditure is done. It's a sunk cost. The clean rooms are already built and depreciated. So when contracted pricing surges for high-bandwidth memory and server DRAM, there is almost zero additional variable cost to produce those specific chips. It's pure structural profit poured right into the foundation of the balance sheet.
Let's drill even deeper into the granular segment data, because the structural integrity holds up across the entire company, not just in one lucky division. Cloud memory, the CMBU segment, hit a record $13.77 billion in revenue, which is up 78% sequentially. And the operating margin? a staggering 78%. Then you have the core data center segment. Revenue climbed to $11.52 billion, which is more than double last quarter, with operating margins sitting at an ironclad 83%. Okay, I admit, the data center margins make total sense right now. Artificial intelligence is a global arms race. But wait, I'm looking at mobile and client. We're talking phones and PCs here. $11.52 billion in revenue and an 86% operating margin? Historically speaking, consumer hardware is a brutal knife fight for pennies. An 86% operating margin in mobile hardware is practically unheard of. It truly is, and it proves the pricing power is universal. Even the automotive and embedded unit pulled in $4.63 billion with a 75% operating margin. All right, I'll admit the current margins are made of titanium. But here's the fatal flaw in your ironclad thesis. What happens when the cycle turns? In prior memory downturns, like what we saw in 2019 and 2023, we saw gross margins melt down below 10%. If demand evaporates, pricing collapses. That's just the nature of the beast.
And that is exactly why this quarter is a completely different beast than anything we've ever seen before. Listen to this direct quote from Chief Business Officer Sumit Sadana. When discussing their new contract structures on the call, he bluntly stated that customers are obligated to pay price times volume, quote, whether they want to purchase the bits or not. Market skeptic? Take-or-pay in commodity memory? That's historically impossible. Nobody signs take-or-pay for a commodity. But that's the whole point. It is not a commodity anymore. High bandwidth memory is a critical strategic bottleneck. If you don't have it, your AI data center doesn't work, period. And this dynamic represents a permanent structural shift in the entire industry's financial architecture.
Let's outline the absolute durability of these new strategic customer agreements, or SCAs. Micron has signed 16 of these binding, multi-year contracts across data center, consumer, and auto markets. They've successfully secured $22 billion in upfront cash deposits and related financial commitments, and $18 billion of that is pure cash already sitting on the balance sheet or flowing in imminently.
I have to ask, why on earth are hardware companies and massive hyperscalers willing to hand over $22 billion in upfront cash? Nobody does that in the tech sector.
Because this isn't just a down payment. This is panic insurance. The biggest tech CEOs in the world are terrified of being left behind in the AI race. They realize that if they don't lock down their HBM supply today, their multi-billion-dollar data centers will be obsolete bricks by 2027. They are literally funding Micron's factory builds to guarantee they get their hands on the chips. 14 of these 16 agreements have a minimum revenue floor of $100 billion over the remaining term. The largest agreements have a ceiling price locked in at current market prices and a concrete floor price. Management explicitly stated that even at these floor prices, gross margins will yield well above their peak quarterly margins in any past cycle.
So you're telling me they contractually engineered out the sub 10% margin risk? They just deleted the cyclical downside?
Exactly. The floor is heavily reinforced. Once all planned SCAs are fully executed, 50% or more of total revenue will come under these agreements. The historical cyclical collapse is now contractually impossible for this covered volume.
And that structural floor translates immediately into explosive future guidance. Management is guiding for a staggering $50 billion in revenue for Q4 at the midpoint, plus or minus $1 billion.
Let me run those numbers real quick. The consensus for Q4 was only $43.58 billion. That's a $6.42 billion beat before the quarter even officially starts. That's nearly a 15% guide beat. Wall Street analysts must be re-entering these digits into Excel right now, wondering if their keyboards are completely broken.
Precisely. With gross margins holding incredibly strong at approximately 86% and non-GAAP EPS projected at an unbelievable $31 per share, this fundamentally re-rates what Micron is capable of earning. It takes their projected annual run rate well over $100 billion for the data center alone. This is an entirely new weight class.
And how exactly are they forging this future? Let's map out the technology rollout. Right now, in the present, HBM4, built on 1-beta DRAM technology, is already in high-volume shipments for their lead customer's platform. They've already shipped over $1 billion in HBM4 revenue and are scaling it twice as fast as the previous generation. By calendar 2027, they are moving into volume production for HBM4E, built on the cutting-edge 1-gamma technology using extreme ultraviolet lithography. Market skeptic. I also saw in the filings they're mass-producing ultra-high-capacity 245 terabyte solid-state drives. A 245 terabyte SSD. To put that in perspective for everyone, you could store roughly 60,000 high-definition movies on a drive the size of a standard ruler. It's an absurd, almost comical amount of local storage. But who actually needs that kind of extreme hardware intensity? The future of autonomous systems. This massive compute memory requirement isn't just restricted to massive data centers anymore. It's expanding into agentic AI,
humanoid robots, and fully autonomous robotaxis, which they are actually already sampling 1-gamma DDR5 to right now. Think about it. A humanoid robot or a robotaxi isn't just following simple code. It's ingesting terabytes of visual data every second, processing it through an onboard language model, and making millisecond physical decisions. You can't rely on cloud buffering when a robot is crossing a busy intersection or pouring hot coffee. The hardware intensity required at the edge is astronomical.
Okay, I see the steel beams going up, and it looks impressive, but no fortress is completely impregnable. Let me push back hard on the structural vulnerabilities here, because I see some serious macro risks that could cause a massive cave-in. First, let's talk about the 2028 greenfield supply risk. Micron broke ground on massive new fabs in Clay, New York and Boise, Idaho, backed by $6.4 billion in CHIPS Act funding. Those come fully online around 2028. What happens if this massive wave of new capacity collides with a sudden demand air pocket?
That's the classic capital expenditure trap, sure. But with $100 billion minimum revenue floors locked in, the downside is heavily mitigated.
Maybe, but what about the HBM oversupply risk? The 10Q explicitly states that if HBM demand weakens, suppliers will shift cleanroom capacity back to conventional DRAM. That would cause a massive flood in supply and instantly crash legacy pricing. And let's not forget the fierce competition. What if Samsung finally fixes its HBM yield issues, or SK Hynix overexpands their footprint by 2027? Plus, you have geopolitical mechanics at play. The so-called Trump shield tariff dynamics, proposing 25% tariffs on advanced chips to protect domestic foundries. It sounds great for U.S. manufacturing on paper, but what happens if Beijing or Brussels retaliates by blocking critical export markets? This is a globally integrated supply chain. You can't just wall it off without massive friction. And finally, what about the software side of things? There is a very real threat of compute-efficient AI models, like DeepSeek R1, proving that developers can drastically reduce overall memory hardware intensity through algorithmic efficiency. If the software gets smarter, the hardware demand drops.
Those are completely valid metallurgical stress tests. The market is heavy machinery. It always carries inherent risk. The tariff dynamics, the potential yield recoveries from Samsung, and algorithmic efficiency absolutely have the potential to introduce volatility. But to answer your doubts, I'll deliver the final verdict by pointing to the ultimate proof of strength: cold, hard cash. In Q3 alone, Micron generated a massive $18.3 billion in adjusted free cash flow. They ended the quarter with $30.2 billion in cash and marketable investments. Let's tie everything together with the valuations. Right now, they are trading at a 15.8x trailing price-to-earnings ratio.
But wait, when you actually factor in this explosive guidance and the locked-in contracts we just talked about, the annualized forward run rate puts them at a 9.4x forward PE. A 9.4 forward multiple on a premier AI infrastructure stock is just absurdly cheap.
Exactly. Plus, you are getting a massive 5.9% free cash flow yield. So what is the actionable trading framework here? If you are just blindly chasing the massive post-earnings gap up, you might get burned by short-term volatility. But deploying a strategic buy-on-the-dip strategy in the $1,050 to $1,100 range, that is building your portfolio on absolute bedrock. The $100 billion minimum revenue floor and the $22 billion in cash deposits fundamentally change the earnings floor for fiscal 2027 and 2028. Wall Street is going to be forced to revise their models significantly higher. So the blueprints are laid, the contracts are signed, and the concrete is drying. The only question left is, are you going to forge your portfolio with iron, or let market volatility shake you out?
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.